So how do you really know if a company is a winner? It's not always about the flashy ads or the big headlines. Today, we're going to pull back the curtain and look at two incredibly powerful tools that let you see what's really going on inside a business. Think of them as a way to grade management's report card, return on assets, and return on equity. Okay, let's get into it.
I mean, this is the big question, right? A company gets all this cash from two places, from investors like you and me who buy their stock, and from lenders like banks who give them loans. But once all that money is sitting in their account, how do we have any idea if the management team is using it well? Are they actually creating value with it, or are they just spinning their wheels? Well, that's exactly what we're here to figure out.
To get to the bottom of it, you've just got to follow the money. The best way to think about it is like the life story of a single dollar inside a company. It's a journey in 4 simple parts. First, the business raises the funds. Second, it takes that money and invests it in assets, the factories, the software, the inventory, all the stuff it needs to operate. Third, and this is the really critical part, it uses all that stuff to actually make a profit. And finally, it gives those profits back to the people who funded it in the first place. Today, we're going to focus on measuring the success of that third step, turning assets into profit. All right, so here's the game plan for today. We're going to start with the basics. What's a business's scorecard? Then we'll dig into our first big metric, return on assets, or ROA, which kind of gives us the whole picture. After that, we'll zero in on what the owners care about most with return on equity, or ROE. And that's when the real story starts, when we compare the two. We'll wrap it all up with the most important part, why the real skill here is in the analysis, not just punching numbers into a calculator.
Okay, first things first. Before we can start analyzing anything, we need to know where all these numbers are even coming from. So let's do a quick intro to a company's main financial reports.
This slide lays it out perfectly. It's a fantastic way to think about this. The income statement is basically a movie of the company's performance over a whole year. It shows you all the action, the sales coming in, the expenses going out, and then the grand finale, the profit. The balance sheet, though, is different. It's a photo, a single snapshot taken on one specific day that tells you exactly what the company owns, its assets, and what it owes to lenders and owners, its liabilities and equity. We're going to need both the movie and the photos to get the full story.
All right, let's get to our first big metric, return on assets. You can think of this as a way to measure the overall horsepower and efficiency of the entire company engine.
So what in the world is ROA? Well, it tells us how much profit a company is squeezing out of all of its assets for everyone who put up the money for them. That includes the profits that belong to the owners and the interest that gets paid out to the banks. It's really a pure, clean measure of how good management is at using the company's stuff to make money no matter where that money came from.
Okay, I know what you're thinking, a formula. But hang on, it's way simpler than it looks, I promise. As you can see, the top part of the formula comes straight from our movie, the income statement. We just grab the income before tax and we add back the interest expense. The bottom part comes from our photos, the balance sheets. We just take the average of the assets from the start and the end of the year. That's it.
Okay, let's actually plug in some numbers here from our example company. So for the top part, we take the income before tax, just over $1.95 million, and we add back that $85,000 in interest. Now for the bottom part, we take the assets from the end of the year and the start of the year and just find the average. Now why do we do that? Well, a company's assets are changing all year long, right? So taking an average just gives us a much more honest picture of what management had to work with.
And when you run the math, you get this, 16.18%. It's a nice clean number. But a number by itself is, well, it's just a number. What does this actually mean? What is this percentage telling us about the business?
And here's the bottom line. This is what it all boils down to. An ROA of 16.18% means that for every single dollar of assets the company has, every truck, every laptop, every dollar in the bank, management is generating about 16 cents of profit for all its funders. Now that is something you can wrap your head around.
Okay, so we've got the 30,000-foot view with ROA. Now let's zoom way in. It's time to look at the one metric that really, truly matters to the owners of the business, the shareholders.
And that metric is return on equity, or ROE. Right, so if ROA was the report card for the whole company, ROE is the report card just for the owners. It answers one simple, powerful question. For every dollar that we, the common stockholders, have put into this company, how much profit are we getting back? It is the ultimate shareholder report card.
And look, the formula here is just as straightforward. The top number is net income, but we just have to subtract any preference dividends first. What are those? Well, it's simple. Some companies have a special class of shareholders who get paid first, so we just remove that slice of the pie.
The bottom number is the average common equity, which, you guessed it, we get from our balance sheet photos. All right, so we crunch the numbers for our example. We take that net income, divide it by the average equity, and boom, we get our result, a return on equity of 15.02%. Now this number tells a completely different and incredibly important piece of our company's story.
Okay, this is where it gets really interesting. We have our two numbers, but looking at them in isolation? Kinda useless. The magic happens when we put them side by side. So let's see what the relationship between ROA and ROE is telling us about this business.
So take a look at this. You can see it clear as day. Our ROA at 16.18% is actually higher than our ROE, which is 15.02%. Now hold on a second. That's a little weird, right? Usually, in a healthy company that uses debt, you'd expect to see the exact opposite. So what on earth is happening here?
And this quote right here, this explains everything. See, when a company borrows money, that's what we call leverage, the whole point is to earn a higher return on that borrowed cash than what you're paying in interest. If you pull that off, the extra profit goes right to the shareholders, and that boosts ROE way above ROA. But in our case, with ROA being higher, it suggests this company is actually paying more for its debt than it's earning with it. And like the quote says, leverage is a double-edged sword. And for this company, it looks like it's cutting the wrong way, and it's hurting the owner's returns.
So, we've got our numbers, we've compared them, we've even spotted a potential red flag with the company's debt. But listen, we are not done, not by a long shot, because the numbers themselves, they're never the whole story. This right here is probably the most important thing to remember from all of this. I just love this quote because it hits the nail on the head. Anybody with a calculator can do ratio calculation. That's the easy part. The real skill, the thing that separates the pros from the amateurs, is ratio analysis. It's all about asking why. Why is the ROA higher? What does this mean for the future? The calculation, that's just the starting gun for your investigation.
And that's because analysis is all about context. You have to look deeper. For example, you can't compare the ROA of a software company to a giant car manufacturer. It's apples and oranges. A rising ROA might look amazing on the surface, but what if it's only going up because the company is selling off its best factories? And believe it or not, simple accounting decisions can totally change these numbers. And as we just saw, a company can pump up its ROE just by taking on a ton of risky debt. You always have to look beyond the numbers.
And that really brings us full circle, doesn't it? Figuring out ROA and ROE is a brilliant starting point for understanding a business. But what these numbers really do is point you toward a much bigger, more fundamental question. If a business can consistently generate a return on equity that's higher than what it costs them to get money in the first place, then it is genuinely creating value. And that, at the end of the day, is the whole point. The ratios? They're just the breadcrumbs on the trail that lead you to that.